We live in a fantasy world now. Reality has been destroyed.
This is the time that you really need to pay attention.
The probabilities are overwhelmingly on gold's side. That is the best environment to see gold increase its value.
Welcome to Palisades Gold Radio. I'm your host, Tom Bodrovics. Joining me today is David Brady, former money manager, Sprott Money, and SilverChartist.com contributor, and an expert on all things gold and silver. Thanks for joining me today, David.
It's great to be with you again, Tom.
Always great to have you, David. So you recently wrote an article about, focusing really on sentiment. So how does sentiment fit into your decision-making process in the metals? And what other factors are you looking for to see a trend reversal in the metals here?
Well, sentiment is a fantastic contrarian indicator, especially in the metals, because the metals are, I would say, a very emotional sector. There's the terms gold bugs and silver bugs are there for a reason. And what I mean by that is, give an example. Back in March this year, when we were going to 2079, just shy of the previous high in August 2020, and everybody was getting bowled up and euphoric and so forth, as we do. Oh, we're going to 3,000, we're going to 5,000. And I'm like, I put out a note 3 days ahead of the peak where I said, guys, the risk reward's turning down here. We're extraordinarily bullish and the whole oversold, overbought, et cetera, et cetera. And it's the same on the downside, which we're experiencing right now. We got people throwing in the towel left and right, much like they did. And my favorite reference point, other people use 2008 as one, but my preferred one is the 2018 low, when the trade war was on with China, and it just kept going down and down, and it seemed inexorable. And we finally hit 1167 bottom. Everybody just got fed up, had thrown in the towel. They just had enough. What happened next? Off to record highs. So sentiment's a great contrarian indicator, but it doesn't work so well in areas like nat gas. You need to rely on other indicators to complement it for it to be meaningful. I find the COT is better for that, for example. But getting back to your point, sentiment with regard to gold and silver. I don't use any tool in isolation. And I like to think that my process, the FIPES process, is unique in the sense that I use multiple tools, and all of which have credibility. Why? Because so many people use them. FIPES, fundamentals. You got your fundamental analysts. Think that like the latest GDP number moves the markets, something like that, right? Then you've got the intermarket analysis for gold and silver. The two that I immediately come to mind would be the dollar and real yields. Those are the two main ones that I watch there. And you could use nominal yields, and you could even silver's moved by its big brother gold and so forth. Then P is for positioning the COT data. I focus on the funds, or what are they called? The money makers, the market makers, money managers, and then the commercials, the banks. Those are the two I follow there. And then you've got Elliott wave theory or Fibonacci's. Sentiment is the S, and T is technicals, classical technicals. And the reason for that is every one of them has value. Now, if you get the Elliott wave theorist to talk to the fundamentalist, they completely disagree. But I see merits in both. The technical guy might argue with the Elliott wave guy. The technical guy will argue with the intermarket guy. My point is, everybody's using these tools, so they must have some credibility. And this is how I use them. I don't look at one in isolation. It's when they all say the same thing, you can have a high degree of confidence that it's going to go, the market's going to go in that direction. Now, there are various strengths to each one depending on the asset you're looking at. As I mentioned, with regard to nat gas, is more heavily influenced by the COT data than sentiment, whereas sentiment is much more powerful in gold and silver. But again, sentiment's in the toilet now. Do I go out and just back up the truck right now? No. I wait to see all the others are in line. And I've said this too in previous articles. Every one of them, but one, is pointing up. You got extreme bearishness, you got extreme oversold indicators, you've got real yields at 12-year peaks, you've got the dollar at 20-year peaks, and people think that's going to just keep continuing, just like they thought gold would go up to 3,000 at 2079. I'm looking in the other direction. You've got the banks are long silver. Do you know how rare that is? The commercials as a group are only long silver for the second time in the whole history of the COT. And then the Elliott waves, it looks like we're in a wave 4 and wave 5, which in metals can be as big as wave 3 or bigger. Just waiting for the bottom, or the bottom is already in. We're just waiting for confirmation with wave 1, 2, and then breakout in 3. And then you got your technical analysis, which is extreme oversold on a daily and weekly basis. So there you go. You got a whole bunch of them. But the one that's missing, which we're going to talk about today, the Fed. Mm-hmm. Fundamentals don't matter anymore because the markets are essentially managed by the central banks and specifically the Fed. So is the Fed going to pivot or not? That's the key question. So I hope I answered your question on sentiment. It is a fantastic tool, and it's actually a very good timing tool when it gets really extreme, which it has recently. The bearishness in both gold and silver reached 2018 lows, the 1167 level, while we're still in the 1600s or 1700s in gold and still around 20 in silver. So we're close to a bottom, but we're waiting on the Fed. And, I hear people say, oh, it's going a lot lower. Yeah, it could. I mean, you could get a positively divergent lower low based on the sentiment and technical indicators, such that it goes lower, but their momentum indicators are saying, yeah, the price went down, but this is going the other way next. So it could go a dip lower, especially if we get a final capitulation / crash in stocks that drags them down, which I think would only happen briefly, because look at what happened in October 2008 and August 2018. In both cases, gold bottomed months ahead of money printing. In both 2008 and 2018, what's to say that doesn't happen again? But it is a fantastic contrarian indicator. But I don't use any one tool in isolation. That's the beauty of my process. The second one is I'm all about extremes. I'm not trading the day-to-day in the middle part. I wait to see extremes, and it requires a lot of patience, but it's paid off so well that I've learned to wait. Mm-hmm. And when it goes up to peaks and everything is screaming, go down, that's when I take a position, or I take some profits, or I go short. Or in the current case, I layer in on the downside to wait for the catapult to take place soon thereafter. Everything else in between is just noise. Mm-hmm. But I'm paid to write articles, so I have to say something on what's going on. But I don't take big positions. I don't day trade. I swing trade, but I'm a heavy investor in gold and silver. Like my metals are gathering dust.
So when we're talking about emotions and sentiment here, I read that emotions are the death of wealth. So how do you manage those emotions? Is your 5-Pest XM system, the best way that you think is helpful in managing those emotions?
Yeah, I mean, look, everybody can develop their own process. Other people have great processes, like Avi Gilbert on the Elliott wave theory, Mancini on technicals, Luke Roman on fundamentals. Everybody's got their strength. For me, I like to use all of those tools. The beauty of it is those tools are all based on data. They screen out emotion. Because I'm using data now, I could become biased on fundamentals. I have a view of what the Fed's going to do, so I believe the Fed pivot from the Fed is inevitable, or we get systemic collapse. Now, based on history, they never allow that to happen. I don't think they will allow that to happen. They will keep kicking the can down the road. The end game for me is the Fed is printing, the stock market goes down. That's what I believe will force the Fed to end QE game, for want of a better term. But going back to the process is data based. And what keeps me honest is the other tools in that process will correct me on my fundamental view if they're really out of step with one another. And having 6 of them and waiting for all 6 of them to say the same thing means that I can't really get emotional one way or another until all of them are in line. The problem with the average retail trader is, and sentiment is a great example. I just mentioned it. They get to 2079, they have big gains. There's a lot of psychological theory around this. I won't get into that, like loss aversion and mental accounting and yada, yada, yada. But in simple terms, when they see it go up, unfortunately, those that bought early think it's going to continue. So they run their gains, much like you would in Vegas on the roulette table or the craps table. Let it run. And then the next roll, they lose everything. I saw that in the dot-com bubble. Friends of mine had bought Exodus stock at $3. It went to 84. They had made, they went from 300,000 to 8 million or something. And then it went back down to 6 million. Then it went down to 4 million. I said, I'm screaming at them, just take half off. You've made so much money. Oh, no, it'll come back. It didn't. It went to big fat zero. Mm-hmm. So not only did they lose all those gains, much like people in Bitcoin recently, lose all those gains, they ran it down to zero. Now, I don't know if Bitcoin's going to zero, but you get my point. If you've got such massive gains, take half off and let the rest run if you really feel that strongly about it. But people don't do that. It's just common sense, but they get so tied up in emotion. And that's what I mean by emotion is the death of wealth. If you let emotion take over, you're going to act stupidly. You're going to do the wrong thing. And that's why I often get into trouble on Twitter, because at 2079, I was the one coming out saying, guys, it's going the other way. Oh, Brady, you're at it again. Shut up. You don't know what you're talking about. What's happened since? Back when we had that interview in July, you remember that? Mm-hmm. Back in July 2020, guys, this is going south. Now it went up a good bit further thereafter. But I said it was going to peak the next month. I didn't say it was going to peak in July. I said specifically, they're not going to continue the checks to Americans. They're going to let it expire, the fiscal policy, in August. That'll be the peak. When did it peak? I think it was August 8th, August 7th. I can't remember the exact day, but it was early August, and then it went down. Mm-hmm. But man, you remember the pushback that I got on that one. And it's the same with the lows. Oh no, now we're getting this. Or we're going to 1,300. Or we're going to sub 1,000. Okay, I haven't heard that before. People never learn, And even if it does go down to 1,300, what is that? 300 from here. I think it's going to 2,300. The bigger the fall, the bigger the rally. And same on the other side as well. So emotion is the death of wealth, and people don't have a process. You can develop your own process. Mine was going back, looking at every major peak and trough in every single asset, using the six tools, looking for consistent patterns at each of those peaks and each of those troughs. And I was not quick to deploy it. What I did was, I tried to gauge what the next peak was or the next trough was based on that process, but I didn't put any money on it. And sure enough, it played out. And then I did it again and it played out. I said, okay, now I can start to lay out money on this because this seems to work. Now I'm not going to get it to the penny, but it's pretty damn close. And I've done the analysis. I said it was 90% effective. It's 88% effective. I'll take those odds any day and twice on Sunday. The problem with that is, why isn't Brady making money every day in a week? Because I only do this at extremes. How often do these come along? It could be 2, 3 times, 4 times a year. Mm-hmm. And the only reason I decided to ditch all the rest of them was because I was getting spread so thin across all the various asset classes. I said, screw it. I'm just going to focus on gold and silver and those other markets that affect gold and silver. But that's how effective it is. But I don't get it to the nearest dollar. And the problem that people have is that they still let their emotions get the better of them, even though they've suffered this so many times. I saw it in the dot-com bubble. I see it every day in gold and silver. Every time we get to a peak, They all get bowled up and they get disappointed. And then it goes down, they throw in the towel. When I say try to remind people at the bottoms, do you remember how it was at 10:45 back in December 2015? Everyone was so bearish that they weren't bearish anymore. They were like completely apathetic, meaning, what? Somebody still buys gold? That still exists? Like people have just walked away from it. And then you had we had the big run up to July 2016, and I called the peak there, and then it went down to 1124 in December, and then again everybody's throwing in the towel. What happened next? It soared back up to resistance at 1365. Then it went back down again in August 2018 to 1167. Everybody's throwing in the towel again. I mean, you could go, there's so many examples, but people never learn from history. I don't know what it is. Short-term memory loss, long-term memory loss, I don't know what it is. But if you just look back at history, it gives you a gauge to eliminate that emotion. Well, we've been here before. I've seen this. You wait for the extreme. You wait for it to go against you, to go down with nothing in play, no money on the table. And then when you see it really, get hammered, and everybody is like complaining about it or bitching about it or coming out with these ridiculous forecasts for another 50% drop, that's probably when you need to lay out money and go, I'm going to go long. And if it breaks this resistance, I'm going to add to that. And the same on the upside. Everybody's euphoric. Yeah, here we go. It's time to like go against the herd. And that's one of the guys that was great at that was James Dines. He was the master of going against the herd. He wrote a book on it. And it was on a mass psychology, the psychology of the masses. And basically saying what I just said. At bottoms you buy, at tops you sell. Now listen to that. Buy low, sell high. It's complicated, isn't it? I mean, but people do the opposite. They sell low and they buy high. So to answer your question, that was a long-winded answer. Developing a process, it doesn't have to be mine. You can develop your own, back test it, whatever worked in the past, and then try it without any money laid out in the future to see, does it work? And if not, tweak it. But there are various individuals have their own processes and they still do consistently well. Mm-hmm. But it's not my process, but it works for them. So develop your own. But that's how I eliminate sentiment, is having a data-based process. And that's why I'm able to stand firm when I get bashed, say, by all this emotion coming at me, because I've got the data on my side.
Mm-hmm. So let's move on to some of the fundamental pictures that we have kind of playing out in the background here. How misguided is calling something the Inflation Reduction Act? Do you think it will do anything of the sort?
Yeah, it'll do a lot of good for inflation. It just adds to inflation. It's not Inflation Reduction Act. Unfortunately, much, and I have to be careful with what I say here, much of what we hear from the authorities, the exact opposite is true. So when they call something Inflation Reduction Act, it means we're getting more inflation. That's all I got to say on that. I'm not going to ramble on that one. That one's easy.
Yeah, that's a simple answer, but it kind of leads us into this discussion about the Fed and its possible pivot. So what, in your opinion, is the reason we will see them at very least slow the rate hiking schedule here?
Well, the two most obvious are a sharp drop in inflation, so that they can declare victory and say their policies are working, so we can take our foot off the accelerator. And I believe that's happening. I've been saying that that's coming because for numerous reasons. We've got the bullwhip effect. A lot of companies like Walmart, Target, Restoration Hardware, etc., took in a lot of inventories, thinking that demand would remain stable or go higher. And now their warehouses are chock-a-block full of the stuff. And now they're trying to offload it at massive discounts because nobody wants it. Because many people are either tapped out on their credit cards or they've run down their savings and they can only afford necessities. So the demand for these items, which was huge when we were getting free money, just evaporated. And now they're trying to get rid of this stuff. On top of that, you got the strong dollar. Strong dollar lowers import prices of everything. So that's going to bring down inflation. What else have you got? There's a few other items. The commodity prices. If you look at commodity prices, even wheat, but all of them, they've all dropped precipitously over the past year. The most notable being lumber. And we can all see what's happening to the housing market right now. They've dropped precipitously. Those take some time. They've got a big lag before they filter through all the way to, first of all, producer prices, but then consumer prices. You're seeing that now. And the New York Fed came out this morning with an inflation gauge, which shows that it was a dramatic drop in the past month. And now we're about to get CPI tomorrow and PPI. Be interesting to see if that plays out, because if inflation has a significant drop, I think you can pretty much expect gold and silver are going to go up fast, because it'll give the Fed, whether or not they do it, it'll give them the room to pivot. And when I say pivot, that can be a complete 180, which I don't expect, at least not initially. It could be a pause, just to see how things play out, how the previous rate hikes have played out. Or it could be a lower rate hike than expected. They seem to be hell-bent on raising 75 basis points. But what if they raise 75 basis points and says, we're going to pause? There's your pivot. Mm-hmm. What if they only do 50? There's your pivot. I mean, it isn't a 180 like Powell did in December 2018, but it's telling you that the ship is turning. And trust me, any sign of dovishness in this uber hawkish Fed, you're going to see the dollar come off. You're going to see everything else go ballistic, especially gold and silver. And I think that's only a matter of time. But let's get to the other way this could end. Something breaks. Now, I don't know how long we have. I could take a week at this. There's just like everything is breaking at the seams, left, right, and center. It's just like, take your pick. It's unbelievable. And what do I mean? What am I talking about? Financial instability or systemic collapse. Because my 2 cents is that the Fed either pivots or we're going to get a systemic collapse. Mm-hmm. Because they're the only game in town. This is a Ponzi scheme. Without the Fed, this all collapses. We saw that in December 2018. And I would argue, I have a lot of evidence to support this, that you're seeing it right now. So where do we start? Sovereign debt. We saw what happened to the Bank of England. The UK was thinking about cutting their fiscal stimulus or cutting taxes when the pound was already under pressure. What happened? The UK gilts went no bid. Nobody would buy a UK sovereign bond. Mm-hmm. The pound crashed. The Bank of England was on course to start QT. They dumped that immediately and quickly reversed to QE. Because if they didn't, the UK had just become insolvent because nobody's willing to buy your debt. So could that happen elsewhere? Yeah. I mean, look at the Japanese. They've got a massive debt to GDP, and they're printing yen to buy JGBs, Japanese government bonds. But then what happened to the yen? The yen crashes. So what do they do to prop up the yen? They start selling their US treasuries to get the dollars, to sell the dollars and buy yen. Mm-hmm. I call it the whack-a-mole game. And could that happen to the US? Of course it can. Because JP Morgan said recently in a headline that they're concerned that there's no interest in buying US treasuries. There's no one left to buy US treasuries. And I've been saying on Twitter over and over again, I keep asking this question. It's a rhetorical question.
Who's going to buy the debt?
Who's going to buy the debt? Because you were talking earlier on about the Inflation Reduction Act. That adds another 1 trillion plus to the deficit. And then you've got what was the other thing? The student loan forgiveness, and that was supposed to be 100 billion. Now it's 400 billion, and then now they're thinking of taking it away and so forth. But let's look at the debt. You've jacked up interest rates to 3.25, probably 4%. 4% of 31 trillion. Now it's not 31 trillion because they're not all maturing tomorrow, but it's going to be a significant number. So, but let's use 31 trillion. That's 1.2 trillion. That's more than the defense spending of the United States. The deficit is already, I think it's 1.5 trillion. I might be wrong on that. Well, somewhere between 1.2 to 1.5. Now you've just doubled that. You're going to have to issue debt to finance your debt, massively increasing debt. Who's buying the debt? The Chinese are selling. The Russians have sold all theirs. The Japanese are selling. If the Bank of England had any, they'd be selling theirs because they're trying to prop up their pound. Who's buying the debt? The Fed has to buy it. They're the only game in town. So that's one of the key reasons why I think they could pivot, is that, say an auction goes badly in the US, a treasury bond auction doesn't get enough bids. Doesn't need to be no bid like the UK one, just insufficient bids. A horrible auction. That might be the start of it. Mm-hmm. So many others. Foreign held dollar debt. You see either a major company or a major bank in emerging markets go bust, and then the domino effect kicks in, because these guys have dollar denominated debt. The dollar's gone through the roof. It's costing them more to pay off the debt. What if they can't meet those bills? Game over. Mm-hmm. Pensions. The UK also stepped in because the pensions had bought a lot of bonds on leverage to increase the returns to be able to meet their obligations to their pensioners. Well, that went bad when they jacked up rates in the US, and rates around the world went higher. So these pensions were holding massive losses, and they were getting margin calls, and they were literally going to go bust overnight. So that's where the Bank of England had to step in. Could that happen in the US? Yes, it could. Junk bonds, my favorite. Leveraged loans are unsecured loans to weak borrowers. In other words, banks lend these companies money, and they get senior secured collateral. Literally, they can take over the company if they can't pay their bills. These are variable rate loans. They're not fixed. So that means as rates go up, the company costs go up. In an arguably recessionary economy where their revenues are already going down, their energy costs are going up, and now their interest costs have just gone. If they borrowed it at 50 basis points, or when rates were 50 basis points or 1%, their interest costs have at least doubled, maybe tripled, maybe more. And there's already a soaring number of defaults in that sector. Now, it's a small sector, relatively small sector of the junk bond market, but it's the canary in the coal mine, as I like to say, because the mortgage-backed securities debacle in 2008 began with double B credits, as everybody saw in the Big Short movie. Mm-hmm. Leveraged loans are the double B MBS today. If they all start to go bust, and Cineplex is about to go bust on their junk bonds. We know Cineplex. If you get Contagion, and by the way, I should mention, if you look at HYG or JNK, the two main junk bond funds, look at them now. Look at a monthly close chart. On a monthly close basis, they're just coming off their lowest level since 2008. Let me say that again. We're in 2022. It's coming off its lowest level in price since 2008. It's worse than March 2020. Think about that for a second. That's how bad it is. You've got triple B investment grade bond funds that are trading below March 2020 lows. That was when we had the COVID pandemic. That was when we had the repo crisis. We're coming off that too, and we're below there. It's insane how bad things are. So my point is, if the junk bond market blows up, which B of A and Morgan Stanley have been warning about recently. They call it there's a rising risk of a credit event, is what they like to say. It's a very polite way of saying everything could go to hell in a handbasket here very soon if we don't change course. So that's a primary candidate. Again, it's a laundry list. Counterparty risk issues have developed. Credit Suisse, Deutsche. There's concerns about those. There's 2.3 quadrillion in derivatives outstanding in the world right now. All it takes is one big bank to go down to take down everybody else, because all of these banks are interconnected. Whether it's via derivatives or loans or whatever, they're all interconnected. And when I hear this ridiculous argument, well, they're all netted, David. Okay, so Tom, I owe you $10. And because you lent that to me, sorry, 10 billion I owe you. You lent me 10 billion. You were stupid enough to lend me $10 billion. I go bust. I default. What happens to you? You probably default too, because you just lost $10 billion. And you see how it goes. So netting is nonsense. You have to take the gross amount. And all it takes is one. So if Credit Suisse went bust tomorrow, that would send shockwaves across the markets. They're selling hotels in Switzerland to pad their balance sheet. The Deutsche Bank has been a candidate for collapse for quite some time, and they're in the news again as well. My point is, if you get one bank and then two, what do you think happens next? You're going to get a domino effect. And with 2.3 quadrillion derivatives on the line, it won't take very long to spread like wildfire. I think what the analogy, what was the analogy I used the other day? It only takes one campfire to start a forest fire. So that's another potential trigger. And these are all happening now. This isn't like some far-flung concept that might happen in the future. This is the here and now.
Well, David, it seems like every time we hear about instability in the markets that Credit Suisse gets brought up, and same with Deutsche Bank. So what about this time maybe makes it different?
Well, I would say it's not different. It's very similar to 2008, which I lived and worked through. And the first sign that I had, as my former boss found out on a Christmas Eve back in 2007, when we held a bunch of auction rate securities, and I told him to dump them. And I told him why, and he did, was because I was seeing credit default swaps soar. And that was the canary in the coal mine for me. I didn't know why, but that was the first thing I saw. I saw, wait, hold on a second. And that was what happened with Credit Suisse. Their credit default swap went through the roof. And that's the first sign. And now they're trying to take all these measures. I don't know if they're going to make it, but we'll see. But then the CEO coming out and saying our financials are sound, starkly reminiscent of this CEO of Bear Stearns back in March 2008. If I've got the right year, I hope so. And I think Lehman said as well. And we saw how those played out. But my point is that again, data, credit default swap spreads went through the roof. And that was the first sign. Now, when they fall, that's when you know things are really getting bad. Because if you remember 2008, it was Bear Stearns, and then the market went turn back up. And then you started to see, and then Lehman was the one that really started the ball rolling. But then it was a different bank every day was getting into trouble. Citi was in trouble. B of A was in trouble. What was the banks that have disappeared? There were a number of banks that were absorbed. Merrill Lynch had to be bought out by Bank of America. It became B of A, Merrill Lynch. Household Finance, they went bust. They were one of the biggest mortgage brokers in the United States. Countrywide, there's a classic. My point is that the first sign was the credit default swap. And then you just have to wait and see if the domino falls. That's the data point that I'm seeing. And that's what the market was saying. And then when you see other names, Deutsche, yeah, it's been around for a while. But now if we get another one, say some bank in Asia, then it starts to get really worrisome, because now it's happening all over the place, which I believe is what is happening. So I hope that answers the question on that one. Now, we haven't even mentioned stock market.
Well, maybe David, before we
Yeah.
get to that, I want to go back to a couple of things that you had mentioned there in that answer. Does the rest of the world matter to the Fed, and how does the dollar's strength affect these other economies? You mentioned that let's say if we see a bank collapse in Asia, or we saw the BOE, also the Bank of Japan have to come in. Does that matter to the Fed?
It only matters. It only matters to the extent that it affects the U.S. and the U.S. banking system, or foreign branches of U.S. banks, like say J.P. Morgan, Tokyo, for example. And again, I'll go back to that derivative position that's outstanding in the world today, 2.3 quadrillion. The point being that these banks are so interconnected on so many levels that if one goes, then two go, then four go, then eight go. So if you look back, a good example of this, which Jim Rickards was part of, was the LTCM crisis back in 1998. You had one emerging market after another collapse. And it was only when they got to Brazil that they put a stop to it. Mm-hmm. Well, the Fed would be forced to pivot if a bank goes bust, say in Asia or the UK, and then that increases the risk of, say, a Citibank collapse or a Bank of America collapse. And you wouldn't want to wait too long because these things spread like wildfire. Because as I cited 2008, it started with Bear Stearns, and then you heard problems with other banks, and then Lehman fell, and then it was like game on. It was a different name or two names or three names every day. I remember it very well. Coming in the morning, who is it today? And the Fed will remember that. So again, I'll say, unless they want a systemic collapse, they will want to nip that in the bud fast because they know where that's going. Because it's easier to save the first guy. But if you've got like 8 or 10 around the world now starting to collapse, then the problem has increased exponentially in terms of its effect on the global financial system. Mm-hmm. So they're going to want to nip it in the bud early. I think that would be my answer. That the Fed doesn't care what happens to HSBC unless HSBC going down takes down Citibank, which, given how interconnected all these banks are around the world, it would. Mm-hmm. If HSBC has a loan outstanding with Citibank for 200 billion or 300 billion or even $1 trillion these days, and they go bust, that could take down the bank. Given the leverage these guys have and the capital ratios they have, as padded as they have become relative to 2008, they're not going to be able to withstand that. And then they'll just go like wildfire. Who's next? Mm-hmm. So yes, they do care to the extent it impacts the US. And this is, remember, we're talking about globalism here. Of course, they have to be mindful of what's going elsewhere because everything's globally interconnected. Whether by design or not, it is. So yes, they do have to watch what happens elsewhere. And will it affect the US? I can't see any way it does not, unless it's some Mickey Mouse bank. But if it's one of the bigger names, like Credit Suisse, maybe not Deutsche. Yeah. Credit Suisse would be a big one.
David, as you're saying, the Fed has a memory of how things go here. You were
being just generous.
Well, they're going to remember how things played out with the banks, right? So if we see the stock market, start to have, let's say, limit down days, how do they react in that type of situation too?
Well, look at how far we've come, especially in the tech stocks. They're getting hammered. Mm-hmm. Right? So let's say we get a capitulation event, a final crash, because they go and they raise rates in their 75 basis points. There's a breaking point for the markets. On the one hand, the markets will keep testing the Fed to see if there's going to be a put. So how do they test the Fed? They keep selling. Are you going to buy? Are you going to pivot yet? No? Okay, we'll just keep selling. Are you going to buy yet? No, we're going to keep selling then. So the issue is if we get a crash or a capitulation event here shortly, where what we've reached 3,500. Say we get to sub 3,000. Some people are calling for 2,200, but I think that's a little extreme. But it could. Anything's possible. You've got to consider the stock market falling, say, 50, 60% in total. What does that do to capital gains taxes? What does that do to potential bankruptcies? What does that do for jobs? What does that do to the tax revenues of the government versus their spending needs? My point is, the stock market is the economy. And the two are so closely intertwined, and Luke Groman is the best. He can talk on this all day. But he's right. If the stock market crashes, much like 1929, but much more so today, because it's like 200% of the GDP, then the US economy goes down with it. So if we get a flash crash at any point where we go down 50%, they're going to have to step in, because the risk that you run is that they're not going to be able to bring it back. Mm-hmm. If they let it go too far, it's gone, much like 1929 all over again. And that's maybe what they plan to do. I don't know. This could be the 1929 Fed. But until then, you got to assume that based on history, recent history over the past few decades, that they're going to ride to the rescue. And the stock market plummeting from here when we're already down so far, that would be another one. For sure. They would have to step in. And then the housing market. The housing market is, I like to think I was one of the first guys to call this when everybody was saying, well, inventories are low. Okay, look, anybody go to school? Supply, and there's another thing called demand. So if supply is low and demand is up here, prices go bananas, which is what happened. But what happens if demand comes down? Inventories can remain low, but if demand collapses, what happens to price? And that's exactly what happened. Here in Toronto, we've seen 40% drop in the space of months. Mm-hmm. I don't know, it's like your neck of the woods, but it can't be far away from that. I mean, I'm quoting Toronto Residential Board. I get the exact term, mm-hmm. but they track the data for the various districts. It gets down to Brampton, Mississauga, Toronto, Central Toronto, all the various districts. So it's really detailed data. And I'm seeing 40% drops in months. Mm-hmm. Define crash. I mean, a bear market supposedly 20%. We're down 40% in months. So what does that do to spending? What does that do to employment in the real estate sector? What does it do to the developers? China can tell you all about that. I mean, we're talked about stocks, we talk about bonds, we talk about various bonds, we talk about sovereign bonds, junks, we've talked about that. Now the housing market. Do you see how many triggers there? I mean, it's a mess. Mm-hmm. Any one of them can take down the system. I'm still not done. War.
But wait, there's more.
Yeah. What about war? What if China invades Taiwan tomorrow? Mm-hmm. They're going to at some point, in my opinion. It's just a question of when. But when? And if they do, is the US going to, is Biden going to live up to his word? We will defend Taiwan. They only got World War III. China versus the US, and maybe Russia joins China on that side, and the European countries. World War III. Hello. Risk of massive social unrest around the world. There's another one. Spending dries up. You get riots. What kind of economy have you got then? Midterms in the US seems like a non-event compared to all the rest of them, but it is a major factor. As Biden wants in stagflation going into the midterms. I doubt it. So I think that last but not least, as I said, I'll go back to the first one, loss of confidence in US treasuries due to the deficits soaring. It may seem a far-off event given what the dollar's doing, but everyone else, as JP Morgan alluded to, everybody else is selling treasuries. Who's buying them? And will they continue? Because you're seeing yields go up, and people say, "Oh no, there's plenty of people buying U.S. Treasuries." The jingoists talk again. Then why are yields going up? Yields go up when price goes down, and price goes down because people aren't buying it. Mm-hmm. So my point is, there's got to be a limit at some point in bond yields where the Fed goes, "Wait, hold on a sec. We can't let this go too far," and you get yield curve control, much like the Bank of Japan and now the Bank of England are doing. Mm-hmm. Well, that yield curve control is QE.
Explicit yield curve control, yeah.
Yes. So that's another one. That's the Fed pivoting. Mm-hmm. It made me laugh when the Bank of England came out and says, "We're temporarily going to reverse to QE to stabilize the UK gilt market and so forth." Mm-hmm. And I said, "Yeah, these guys have moved to QE infinitive," and people would say, "No, they said it was temporary." Really, you buy that? What happens when they take it away? It's just going to happen again, because nobody wants it. So, and what happened? They had to step in again. So they tried to pull back, and then they had to step in again. So my point is that is probably one of the biggest risks. It may not be the first, a sovereign debt crisis in the US. And US jingoists won't believe that. They look at the dollar, they'll cite the dollar. Look at the dollar strength. Everybody loves our currency and our debt. No, they don't. Look at the yields, they're going up. The dollar's getting weaker. No, it's not. It is. It's just falling slower than everybody else. Mm-hmm. How do we know this? Inflation officially is still around 8-9% at a consumer level. It's much higher at the PPI level. And if you go to shadow stats, it's in the teens or the high teens. That's devaluation of the dollar, my friend. So don't tell me the dollar is strong. None of them are strong. Fiat currency is collapsing. It's just the dollar is falling the slowest. So there are so many triggers for the Fed to pivot. So many. In the bond market, the stock market, the housing market, geopolitical events, the economy, social unrest. I don't know where to stop. I mean, I've got a few more, but let's cover the main ones. Mm-hmm. And that tells me, look, I think a pivot is inevitable unless the Fed is intent on collapsing the economy. Unless their goal is to create a systemic collapse, which would pave the way for a one world government, which would probably destroy the dollar, which would pave the way for a new global reserve currency. Unless that's their intention, of course they're going to pivot. I think they will pivot, and it's when their QE and rate cuts no longer work, it's game over. Mm-hmm. Because it doesn't matter how many bullets they have, they're blanks. They don't work. The Fed is printing and the stock market continues down. That says it all.
And is that just the total lack of confidence that the market will have at that point?
Yes, they lost all confidence in the policies. Someone said recently, when you see these guys doing the same thing over and over again, and you realize that it's never going to end, that's when you lose all confidence in it. Mm-hmm. If you think when you realize that's the only game in town, that this is truly a Ponzi scheme, you lose all confidence in it. And we're getting to that point. I mean, it was 6 trillion, I believe, after March 2020. What's it got to be? If US Treasuries go no bid, or they have to step in a big way to buy all of the debt, and junk bond debt, triple B corporate debt, student loan debt. We didn't even talk about municipal debt. There's another one. That's looking really hairy as well. What happens to the Fed balance sheet? Goes from up to 15 trillion, 20 trillion, 25 trillion? When does everybody else lose all confidence in US policies? We're in Weimar Germany territory at that point. Mm-hmm. You're just printing to buy more and more debt.
All of a sudden, Janet Yellen will be yelling about the debt ceiling again, right?
What debt ceiling? There is no debt ceiling. So yeah, that's the potential end game, and the smart people will see that in events. I would argue that the Chinese and Russians are already anticipating that, and the central banks around the world, that's where they're buying gold and silver. And yeah,
David, right in that line, you always say to follow the smart money. So is that one example of where that smart money is headed? You also put an example of Bridgewater buying into 3 physical backed gold ETFs in China as one of these examples.
Yes. Yeah, it's that. It's just like Goldman going out and buying assets that the UK pensions were selling after the Bank of England debacle. They were dumping them, the UK pensions, to survive. And guess who's buying them? Goldman. Now, what happens today? The Bank of England steps in. Goldman doubles their money overnight. Watch their actions, not what they say. Watch what they do, and it's the same thing. What you just described. It's the same thing on steroids. China and Russia are buying gold and silver. Sorry, China, Russia, and India are buying gold and silver because they anticipate a new monetary system, much like the IMF does. They've been talking about it. And the likes of Willem Middelkoop and Jim Rickards and so forth have been talking about this since I started reading the books back in 2010. Mm-hmm. And now it's coming to fruition, is that the dollar is going to fall. Maybe Brent Johnson is correct. It's the last to fall, but it's going to fall. Mm-hmm. And you want to have gold and silver. And it'll fall because all confidence is lost. And this is the other thing. A lot of people debate. They say that the globalist institutions like the IMF, the UN, the World Bank, the Bank of International Settlements, they're, especially the latter, they're rolling out central bank digital currencies. They will not use gold. I agree with the argument. Well, look, if confidence in fiat currency in general is collapsing, nobody's going to buy a central bank digital currency that can be printed at will either. So it's probably going to be backed by gold, at least initially. They can strip it away like they did in 1971 and back in 1944. But at least initially, it's got to be gold backed or backed by something. And the BRICS version of the new global reserve currency is a basket of currencies backed by commodities. So and gold is one of the key ones. What do you think happens to gold and silver when that happens? Why do you think China and Russia and now India are just loading up on gold and silver? Because they know what's coming. What's backing the US dollar? Is it the petrodollar? Somebody asked the Saudis based on what they just did with the Russians and the Chinese. It really looks like the petrodollar is on its deathbed. Mm-hmm. So what's backing the dollar? US Treasuries. Good luck with that. My point is that, all jokes aside, we talked about all the triggers. I believe the Fed pivot's inevitable, but whether I'm right or wrong, what is absolutely inevitable is that you're going to get another Great Depression, because all of this has got to come crashing down. I just believe that the Fed will kick the can down the road, delay the inevitable as long as possible. But I've said numerous times too that I believe that's mid-2023, latest early 24. So time's running out fast. And then you get your Great Depression, you get your Great Reset, and the next dark ages, in my opinion. But in the short term, yeah, of course they have to pivot. Mm-hmm. It's just, what is going to be the trigger? And they need an excuse. They have to be able to say, oh, these guys are in trouble over here, or this market's in trouble over. We didn't do it. We're never to blame for anything. We have to find an excuse to pivot, but it's somebody else's fault. And something will pop up. Mm-hmm. So I don't know what it is.
David, does the path toward the world turning away from the US as their reserve currency, is it going to look like more extreme versions of what we've seen, more volatility and instability?
Yeah, or it's I tweeted something about that about 4 weeks ago. It said that, yeah, you're going to see a big increase in volatility in the months ahead. And I'll be honest, it could be tomorrow. It could be 3 months from now. But I think before the end of the year, it could be, as I said, it could be tomorrow. It could be December 24th. My point is, it's coming. Mm-hmm. And I would argue you're already seeing it. When I'm citing numbers like real yields are at 12-year highs, junk bonds are at their lowest since 2008 on a monthly closing basis. You've got the Fed raising rates at the fastest pace in history. The extremes are all over the place. That's volatility. The only argument against that is that it's all in one direction right now. But when you start getting this, that's when it really starts to get hairy.
Mhm.
And I think that's coming. Look, when we get something's going to give here soon, something's going to break, and they are going to have to step in because look, the BOJ is already in trouble. The Bank of England's already had its problems and it's still dealing with them. ECB is probably next, and then it's the Fed's turn. Look, they made this whole system global in nature. And global problems require global solutions, which has been their design all along. So we're going to have major global events here play out soon. And at the heart of it is the Fed.
Mhm.
The funniest thing I think about all this is the doublespeak that we're getting from the globalist institutions. The IMF on one hand is telling the Fed to stay the course, do not cut rates, do not pivot. And the UN and the World Bank are on the other saying, yes, do stop raising rates. What game are you playing? I mean, you're just trying to keep us unstable, or we don't uncertain of what's really going to happen. You want to keep that going. I don't know, but the two of them are. These guys are in a room, like I'd say, or on the phone with each other all the time. So for them saying to say the exact opposite, I don't know what the game plan is, but there is some kind of game plan going on there. But what I'm much more certain about is something is going to break. It's stocks, bonds, housing market, economies, emerging markets. I don't know. There's just so much at extreme. It's like elastic band. You keep pulling it, you keep pulling it, and keep pulling it. And at some point, one of these is going to snap back.
Mhm.
Do I know when? No, I don't. But I do know it's coming.
Mhm.
And I'm not talking 23, not talking 24. I'm talking the next day, week, month, 3 months tops. But it's coming. And when that happens, the Fed will have to revert to QE. Well, will they cut rates? You could have this ridiculous situation where they keep rates high as they said they're going to do, and they're doing QE on the back end. But then negative rates are idiotic as well. I lend you money, and I've got to pay you to lend it to you. Where does that make sense? But in this climate, if that plays out, your safe harbor to finish is gold and silver because you can't print them.
Mhm.
They are scarce. Oh, and a quick aside, which is important, we didn't get into this, and we can do another podcast on this, a whole one. But Andy Scheckman has been all over this. Rob Keynes has been all over this. Craig Hemke has been all over this. Inventories are being drained left, right, and center. SLV is being drained. The LBMA or LME, London Metal Exchange, that's their record low inventories. And the COMEX is being drained. You and I can't take delivery from these guys. Only the big boys can do it.
Mhm.
Who are the big boys? I'm guessing they're somewhere east of us. And they are draining at low prices, very low paper prices. Reminds me remarkably of 2018. What happened in 2018 in August, around the August timeframe? Maybe this is a little later this time, but I think this is getting ready for a reset and that they're going to go ballistic. Now, could they go down? Yes, anything is possible.
Mhm.
But there's just so many reasons why it's going to go in the opposite direction. And I don't day trade this stuff. I'm waiting. I like to put it this way. We're closer to the bottom than we are to the top. That's coming next. And follow the smart money. Yeah, just follow the big guys. They're draining everybody. Look at I mentioned earlier, Nick Baird's import-export data. The exports going into Switzerland and coming out the other end are all going to China, India, and to a lesser extent Russia, because they've already got a ton of gold. But they're all going east.
Mhm.
when prices are at mega lows, in my opinion. Like, people ask the question, why is gold going down given all the inflation? Shouldn't it be going up? Yes, of course it should be. But if you're a big player and you want to buy at the lowest price, how do you do that? You drive down the price in the West and then you buy it on the cheap and ship it over. That's what's going on. One of these days, just like in 2018, it's going to go ballistic. But I think a lot of retail investors will have been squeezed out by then, unfortunately. They always are. And that goes back to your original question, sentiment.
Exactly.
Right at the low, we did a nice full circle there. It wasn't planned. But full circle, yeah. When this takes off, everybody else has, cashed in their chips and taken their losses. And then off it goes again. Yeah. It's going to go ballistic.
Well, I think that's a great way to wrap up on that nice little circular tie-in there, David.
Yeah.
Of course, your Twitter feed, you put a lot of information up there at Global Pro Trader. Is there anywhere else you want to point to, David?
Well, I'm at sprottmoney.com. I produce an article for them weekly, and I also do the same for silverchartist.pro.com, where actually I effectively tweet on that platform as well, almost daily. Sometimes I post it there ahead of Twitter to give those guys the benefit of their subscription. But those are the two places. Three, I should say. Twitter, sprottmoney.com, and silverchartistpro.com. That's where you can find me and all.
Perfect. Thanks so much for your opinion and everything you brought to light today, David. Really appreciate it.
I just hope it all works out, Tom. I don't have a crystal ball, but I'm telling you, if I had this many aces in my hand, I would feel comfortable going all in, because this is going to happen. There's no way around this. Something's got to give. So I leave on that note. We could talk all day, but I think that says it all. The foundations are crumbling.
Great way to put it. David, thanks so much for your time today.
Thank you, Tom.
This podcast is for general informational purposes only. Nothing on this podcast should be taken as investment advice. Guests on this show are not compensated for their appearance. Listeners are urged to educate themselves and make their own decisions. Do not base any investment decisions on the information contained. To view our full disclaimer, please visit our website.